In this video, we're going to start our discussion about project risk. How do we assess, how do we quantify the risks that are associated with corporate projects? So what we're looking for, again, we're looking at these cash flows and we're trying to assess the riskiness, the uncertainty of those cash flows occurring. So what risks are involved there? Right? Well, we've talked about certain other kinds of risk or specific things like business risk, financial risk, etc. But let's think a little bit differently. What does risk mean with capital budgeting? And it's the uncertainty about the project's future. We can measure it several ways. We can use standard deviations. We can use beta. So the question we ultimately want to ask, we can measure those things, but the question we ultimately want to ask is, will taking on a project increase the company's and the stockholders' risk? If it does, then that certainly alters what happens to expected returns, since obviously the risk and returns are always tied together. Now, should risk always be historical? Can we actually even calculate it, right? So sometimes historical data doesn't do enough for us, right? Of course, always historical data never really tells us about the future. It tells us what has happened currently up to this date, and then we apply what we think is going to happen to try to understand how things should react. But certainly there are some subjective risk elements that we need to interject into the discussion. Some of those will be quantifiable, some of them not. So it is a very complicated part of this decision-making process. There are three basic types of risk when we think about capital budgeting: standalone, corporate, and market risk. So let's see if we can define them. Standalone risk. This is the project's risk if it were the company's only asset and they had no shareholders. So we don't care about diversification at all. All we're looking at is standard deviation. So we would measure, again, the coefficient of variation or standard deviation of things like net present value, internal rate of return, etc. And of course, those statistics are available in our analysis. So this is how we might measure this standalone risk. And of course, just like any risk analysis, the flatter the distribution, the larger the standard deviation, the greater the amount of standalone risk there is. Now, since this ignores diversification, right, it might not be the best measure of risk of a project. So what other kinds of risk do we have? The next risk is called corporate risk. This looks at the project's effect on the company's earnings stability. So it looks at diversification within the company. So this is going to be impacted by not just the company's standard, the project standard deviation, but also is going to have an influence on the correlation with the rest of the company's assets. Now, how we would measure this is by something called the project's corporate beta. So essentially, what does this mean? Here's project X. We're going to add it to, here's the rest of the firm, the dotted line. So we're going to add this solid blue company to the dotted line. Well, what happens if the correlation equals 1, there would be no diversifiable benefits. However, if it's less than 1, and it's almost always going to be less than 1, there will be some diversifying benefits. So you can see that in the end, the total firm, it's smoothed out just a wee little bit from what it used to be. So this gives us, again, some reduction of uncertainty since it smooths things out. Now, market risk reflects the project's effect on a well-diversified stock portfolio. So this now looks at the stockholders' investments, right? So this is going to depend on the project standard deviation and how that relates to the stock market, the correlation with the stock market. So we're going to measure this with the project's market beta. So now we've introduced different kinds of betas, right? We have market beta, we have corporate beta. We're going to talk about asset beta, right? All of these things, we understand what beta means. They just have different contexts in how we're using them. So market risk is theoretically the best risk for us to use in most situations. But creditors, customers, right, our suppliers, are the people that are our stakeholders, not shareholders, right? They are more affected by corporate risk. So corporate risk is also important. Standalone risk is the easiest to measure. It's a lot more intuitive. So what's the answer? Well, core projects, projects that are highly related to your other company's assets, right? They have a very high correlation. So standalone risk generally reflects very closely to corporate risk. Now, if a project is highly correlated with the economy, then standalone risk also reflects market risk. So we really are in the end, right? If we're interested in how this project will influence the company, standalone risk seems to be the best. But if we're looking at how it might affect portfolios, the portfolios of its shareholders, we now need to kind of think about, okay, well, how correlated is this project with the economy, right? Again, we're using its market data, right? So if we can estimate or come up with a market beta for the project, then we also have an idea, right, of the total risk that's going to be felt by the shareholders of the company. So that's an introduction to risk. We've got more to come. See you soon.